Hello again, everyone. It's Vince Farr from TradingWinds.com. And today I want to talk to you about moving averages. A lot of people use moving averages to trade. We're going to talk a bit about which ones are the most effective and why. And more importantly, I'm going to share with you a couple of little tidbits that will really improve your accuracy, when it comes to trading with moving averages. Most people use them, either use a couple of different moving averages together, and when one crosses the other, that's when they get in. When it crosses back over, they get out. Those types of strategies are all great while a market is trending strongly in one direction or the other. The problem becomes when the market is kind of going sideways. So recently, we have seen a very volatile, very range-bound market. Your accuracy level would not be high at all during a period of consolidation like that. So how do you avoid getting chopped around during times like that? I'm going to share that with you today. I'm also going to share with you several different little tips that when you're using moving averages, they just will automatically improve your accuracy. Okay, so let's get started. Let me share my screen here so you can see what I'm referring to. This here is a chart of the SPY. That is the ETF for the S&P 500. Now, the same concepts apply to any type of chart. First of all, any time frame, whether it's a 1, 3 minute, 5 minute, a daily, weekly, month, it doesn't matter. An index, a stock, a futures contract, Forex, Bitcoin, it doesn't matter. As long as it's a chart, same principles will apply. Okay. Now, on this chart, what I have here are two very short-term moving averages, a 5-period EMA, exponential moving average, in white, and an 8-period exponential moving average in yellow. Now, I'm just showing you these two, and we can change, and I'll show you higher period moving averages as well. But I just want to show you on the very short-term ones, because you get some very clear examples when you're using short-term moving averages. But the main moving averages that most people use, and which is why you may want to follow these moving averages, is because most people use them. That's how, any moving average will work from time to time. So you can pick a number out of the air. You can say, a 182 period moving average. If you plot that on, you're going to see price crossing it. You're going to see price come back to it and bounce off it. Every single moving average will look good at times in the market. But the reason why you want to follow the popular ones is because of that very point. A lot of eyes are on those moving averages, throughout the trading session. So the main ones are the 8-period exponential moving average, the 20-period simple moving average, which is the one I personally use the most, the 50-period moving average, the 200-period moving average. Those are the main ones that most people follow. But again, whether you're using those exact ones or a combination of them or any other moving average, the concepts are all the same. What I'm going to show you can be used with any moving average. Now, what you want to look for, and let's use the most common approach, which is a cross. So a moving average crossover system would work like this. If moving average or price is dropping and then suddenly turns around, what you want to see is one moving average crossing over the other. So it's always the shorter term moving average that reacts a little quicker. So in this case, the white line being the 5-period EMA versus the yellow being the 8-period. So when the 5 crosses above the 8, okay, that's when most people would enter. Now, here's why you do not want to do that, or you want to add another piece to it. Okay? For example, here we are, where price is dropping, it's below both moving averages. Then suddenly the 5 starts to cross above the 8 and price moves above, which is an important thing to look for. But the trade quickly fails, right? It goes up, but it doesn't follow through. It quickly fails. Then it crosses, but this time it moves forward. It follows through nicely, and you have a very nice winning trade. What is the difference? Well, the one thing to remember when you're using a moving average cross system is that not only do you need the shorter term moving average to cross above the longer term moving average, and not only do you need price to move above both of them, but you need price to move above a previous pivot. Okay. In this case, a previous pivot high right here. So by pivots, what I'm referring to is, price usually moves in a zigzag pattern, right? Ebb and flow here. So like this. So it's these turning points that I'm referring to as pivots. So this is a pivot high. This is a pivot low. This is a pivot high. This is a pivot low. So when price crosses above, you're looking to your left and you're looking for the immediate, most recent pivot high in this case, when you're thinking of going long. And so in this case, when price crossed over and the moving averages overlapped, price did not take out this high and it failed. Okay. Now, doesn't mean it's always going to fail. There are times where it crosses and just takes off. Yes, nothing's 100%. But if this was about to begin a consolidation phase, okay, a phase where price kind of moves sideways between two levels. So, it kind of moves back and forth like this in a channel pattern, right? So if it's something like this where you can clearly sort of mark the highs and mark the lows, that's what a consolidation phase is. So to avoid getting caught up in that, because this is where most traders lose money. They get in and they get stopped out, and they get in and they get stopped out, and back and forth, back and forth. So you want to avoid these flat areas. And one of the easiest tricks or methods to use to avoid that is to wait for a break of the previous pivot high. So once price not only moved above both moving averages, but the shorter term moved or crossed above the longer term, and price moved above that prior high, now you're pretty confident that you're going to see a nice move. And if you're looking for an overhead target where you might think you could start to take some profits, if you look to your left and there is an even higher pivot high, that would be an area where you might at least take some partial profits or reevaluate your trade. So entry here, profit here, at least a portion of yours, and then carry through. If there are further pivot highs back here, you just keep targeting those previous pivot highs, okay? The other thing you should always look for in moving averages is slope, okay? The degree of slope. So if you look at both the 5 and the 8, not only are they in the right order, right? The shorter term one above the longer term one, but they are both sloping higher, okay? And the higher the degree of slope, the better. That means there's more momentum behind this. So when you get to the point where you're entering, if you look back in here, you could have said maybe they were just starting to slope, but it wasn't as clear. At this point here where it takes out this high, look at that degree of slope on both of them, and you can clearly see the separation between them, right? The 5 above the 8, clearly sloping higher, break a prior high, and off we go. So that is exactly what you want to see there. If you follow, you look for this group of characteristics when you're trading with moving averages, you will trade with a high degree of accuracy. And as I said, it is not just a daily time frame. You can look at weekly, for example. Here we are in the weekly, right? And look, here's another perfect example, okay? Market is trending, it's moving higher. Then we see a pullback, and we see those moving averages come together, or the 5 just cross below the 8. Then it crosses back above and price moves above, right? But what happens next? It immediately pulls back. Let me zoom in here. Let me zoom in here so you can see it a little clearer. There we go. So price moves down, it crosses back, but it does not take out that prior high and immediately fails again. Okay. Now it crosses back above, and you can see here again, 5 came on top of the 8, started to separate again, right? It's all good. But did it take out the prior high? Not on this candle, not yet. It did here. Okay. And from here, you have an easy path. And if you look at where or what the moving averages were doing at this point, when you get your entry, They're both sloping in the direction of the trade, which is what you want. And then you have a nice, easy trade. Okay. Now, in a situation like this was the pandemic where we had basically a market crash here for a little while. Then it started to recover. Now, the prior high is all the way up here. So do you want to wait for that, or do you want to just take the cross? The answer to that question is how aggressive of a trader you are, or how conservative are you? Personally, I'm very conservative. I would ignore this here. I would wait for this prior high to be taken out. And I may be waiting a while, just like I was here, several weeks for that. But once we cleared this high, right? A strong move happened. It was well worth the wait. And I can go back and you can see how big that move was, right? And so it is worth waiting. Trust me, you want to have patience when you're doing this. Okay. So just a couple of quick reminders. And I can show you on a higher time frame. Let me just show you the two more time frames. You look at the monthly chart. Look, here's another perfect example. Market is trending nicely, right? It pulls back. It crosses back above the moving averages, and both moving averages start to cross over again. And it looks like we're about to go for another move. What happens? It immediately fails. But how could you have avoided it? If you had just waited for it to clear that prior high here, which it did not, right? It pulls back, then it crosses again. Once it does clear that prior high, off it goes, right? Okay. It's not 100%. For example, like here, we pull back, we cross over, but the moving averages were still separated, right? They did not cross. So not an official entry using the cross method, but just price dropping. Actually, now that I look at it, price never did close below both moving averages. So this doesn't even apply. But there will be times when, you get that move below, it crosses above, it just barely takes out that high and then fails. It'll happen. You're not going to have 100% winners. Don't go into trading, into this game, thinking you're going to be right 100% of the time. It's not. Losses are a cost of doing business here. You're going to have losses. The key is to keep those losses small. So on something like this, you would immediately get out if it crossed back below the moving averages, and you'd be out with a small loss. But again, if you wait for it to cross, have the moving averages cross, wait for it to take out that prior high, wait for a slope, and boom, off it goes. Look at here. The entry is above this prior high, and look at that move. That's exactly what you want to see. Works the same on a 1 minute, 3 minute, you name it, stock, futures contract, Forex, crypto, anything you want. All right. Thanks for watching. We'll see you on the next video.